The theme of today's discussion with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com, is cycles. Cycles for stocks, cycles for gold, cycles for trading, everything you need to know about cycles. Chris, welcome back.
Hey, thanks for having me, David.
We spoke 2 weeks ago. You were all in cash, awaiting a drawdown in equities and Bitcoin and potentially gold as well. We haven't seen a big correction yet in either of those markets. Can you give us an update?
Sure, yeah. Well, we are still in cash because the stock market internals, the technicals, using cycles, intermarket analysis, all those things are still pointing to the stock market is giving a real kind of neutral mixed signal. And when it gives a mixed signal like this is when really it's not favorable to be in stocks. We've got a lot of new triggers, buy triggers on most of the sectors, but believe it or not, in the last two or so weeks, almost none of them have generated any gains. They're plus or minus, 1, 2, 3%. So it just goes to show us that even though the market's trying to go higher, there's really not a lot of momentum behind it. There's not new money piling in, chasing prices up, looking to make easy money. So that when that dissipates, that kind of big surge of money, that's when our system says, hey, there's not a lot of momentum behind this. You should just step aside, let it chop around, let it do whatever the market wants to do. Forget the roller coaster ride, and we'll get back on board when we know it's headed back uphill or potentially downhill. We can try to benefit from a collapse in price as well.
Mm-hmm. Well, the consumer sentiment index has been improving, but what about the stock market sentiment? How would you describe sentiment over the last couple of weeks? We've seen the stock market, as you say, behave in a choppy manner, going just sideways. I haven't felt a lot of fear. I haven't felt a lot of euphoria either. How would you describe the sentiment?
Yeah, I think a lot of people seem to just be in limbo. I mean, maybe it's because kind of summer weather's here. Maybe people are kind of schools like ending. I think maybe people just don't have their mind in the game. In the stock market right now, it really feels like it's been very dormant. There's no real direction. The market's trying to find leadership. It doesn't know where the next leaders are. Last year was tech, clean energy, that side. This year, it's more or less been dirty energy like crude oil, and precious metals are coming into favor. We've seen real estate and financials start to come to life. The market just doesn't have a real clear signal as to where money should be dumping into and driving higher. Now, we have been seeing commodities start to move higher. We've been seeing crude oil hit multi-year highs. Precious metals are in a major super cycle to the upside. They've been moving higher over the last couple of months. And when we see energies, commodities, precious metals start to move higher, you can see from an economic chart performance of what happens. Usually we see precious metals and energy outperform just before the stock market puts in a top. And this outperformance could last several months. It could be 2, 3, 4 months. But we're starting to see these come to life. And that, to me, is telling us that we're close to a potential stock market top, which is this blue cycle here. So we got to be very wary of what's going on because the market's lost a lot of momentum.
Okay. It's too bad you didn't apply your own captions this time. Those were funny. You should do that for every chart. Okay, so we're at a top here. Now, the old adage is that it's difficult to time tops and bottoms. So I want to ask you, Chris, why do you think we're at a top right now? What makes you think that this can't go any higher?
Well, I'm not saying it's up. I'm just saying when the market gets weak and it's kind of topping out for some type of pause or pullback or correction, we tend to see commodities perform really well. I do feel like this cycle here, this chart, is a major economic cycle. If precious metals start to rally in a huge way, I think that will be a more clear indication that this could be a major bull market top coming.
Okay.
But the reality is we're still in a bull market for stocks. In an investment account, technically you should still be long equities for the long-term play. Right now, the market is giving mixed signals. It's consolidating. When you look at the NASDAQ or the Russell 2000, which I can show you really quick here, if we were to take a look at the Russell 2000, it has been trading in this multi-month consolidation, really the past 1, 2, 3, 4, 5 months. And this is a pause that if it breaks to the upside, we're going to see a very big rally. It's probably going to be that blow-off euphoric phase in stocks. I mean, stocks have already had a huge run, but I think we could see the NASDAQ break out. The NASDAQ has done the same thing. If we look at the NASDAQ chart, you can see it has traded. This monthly chart doesn't really show the best version of it. Let me show you the daily chart. You can see how we've consolidated in this big sideways pattern. Well, what happens is the stock market does this over and over again. It'll rally, it'll consolidate for a while, just like it did last year, starting out in September. Well, it had another rally, it's consolidating. The odds are it's still going to move higher. But we have to be aware that the market is mixed right now. And when it's mixed, it could sell off, it could break down, and then go into a much deeper correction. And I do feel like there's a 10 to 15%, maybe even bigger correction in the stock market brewing. But I don't pick tops. And that goes back to your question. You can't really pick a top and you can't really pick a bottom either. You got to wait for the trend to confirm the direction, and then you jump on board. So you're never going to get out near the top, and you're never going to buy in near the bottom. If you do, you've most likely, taken a stab, throwing a dart, hoping and praying that you pick the top or the bottom. And in that game, when it works out, you make a fortune, highly addicting. And that's the problem most people do, is they throw these darts, they try to pick tops and bottoms, and when they land one, they make a fortune, and then they think that's trading. And that's really the worst thing somebody could do, is try to pick a top or bottom and nail it, because it's not going to happen very often. And it's a great way to be on the wrong side of the market and lose a lot of money.
Yeah. What you're saying right now is that we're potentially due for a correction of 10 to 15%. We talked about this last time. You've also talked about a potential breakout. What is more likely right now, Chris? And what are the buy signals you're looking for?
Yeah, so it's more likely to break to the upside because we are still in a bull market. The underlying trend should hopefully support it and go higher. As much as a lot of us technical analysts think that the markets are overdone to the upside, the underlying trend is still clearly up. The best opportunities are still to get into stocks for generating positive returns.
Right.
So I think that's the scenario going forward, is to expect a break to the upside, but you don't really want to get in until this market shows big momentum and it shows leadership in some sectors and starts to move higher.
Well, one could argue that correction we had last year in March and April, that was a blip. And that was just it was a blip along the bull trend, because if you go back to your cycles chart for economic and stock cycles here, I don't see any place in that chart for explaining what happened in March last year. So I assume that was just that was a correction in the middle of a late bull cycle or a middle bull cycle. Is that correct to say?
Yeah, I mean, it was a big enough correction that typically, like when you look at the stock market, if the market collapses, pulls back more than 20%, a lot of investors will say, okay, well, that's a bear market. It happened so quick, it dropped enough.
It bounced back right away. That was the key for most people. Like the velocity of recovery was really fast.
Exactly. Well, it was an event-driven move, right? And I talk about this with followers and subscribers all the time, is when there's a huge move in a stock, a commodity, an index based on some type of news event, something that moves it, it's going to be very quick, and it'll usually give back half or all of the gain. And the COVID crash was a huge event. It created mass liquidation, and then it rebounded very quickly. And then, it just continued to rally from there, which is pretty astonishing. But it was definitely a big blip in a bull market cycle. It recovered so quickly that the moving averages never really got to cross to the downside, and it just kept on going up. So that was a really godsend that it popped right back and saved everybody. Eventually we will get into a bear market, something that lasts 8, 12, 18 months. And those are what you don't really want to go through, because those are painful, very long periods of watching your account draw down dramatically. I mean, if you take a look at this
bear market, when was the last time we had that? I don't remember that.
Well, we had a market top back here in 2007, and from there, when my investing signal and system gave a sell signal, I mean, the market fell 54%. It didn't come back to a new buy signal to confirm a bull market until 2009. That's a long time to be sitting, holding this, and all this was huge chaos. And of course, this happened back in 2001, massive, depends if NASDAQ was a big drawdown for a very long period of time. But there's times when you just need to move to cash or get into bonds or something else, right? And so that's kind of the scenario that we're in. Right now, when we look at technology like the NASDAQ, we're in these red bars, which means it's unfavorable. The market could break lower very sharply at any time. And so there's no point in holding them. We'll wait for it to confirm, give us some type of green bars telling us, hey, big money's moving into the stocks. They're getting aggressive. They're buying leading stocks again, or there are leaders really powering their way up. So that's what we're looking for, is to get green bars, which is telling us from a technical standpoint that big money's moving in, and we want to ride their coattails.
So, Chris, people might be wondering then, if the longer-term trend is still bullish and you're expecting a breakout to the upside eventually, why wouldn't you get in now and just ride it out? Why would you be positioned in cash? Aren't you concerned about missing out on gains, potential gains?
I'm not worried about getting in at a higher price when things are confirmed and things run higher. For example, if you look at the COVID crash, you could have bought in after it pulled back 10% and said, hey, I could just get in. Problem is, one of these times, and this is what most people don't fully grasp, is one of these red bars eventually, these times in the market, it's going to be the start of something bigger that is going to take multiple months, potentially several years to play out. And you'll wipe out, 10, 15 years worth of growth, and then you'll be dormant trying to get back to break even for years after that. And it's just not worth it. I'd much rather just step aside. If the market goes up and say the NASDAQ here breaks the new highs, we start to get some green bars, I'll jump into the leading sectors. They should rally and outperform and beat the market dramatically versus, just getting in now and hoping and praying that it's going to go higher. So it's not about being like, I'm not a greedy trader whatsoever. I'm constantly just looking for get in when the going's good, get out when it's mixed and there's no signals there. Because eventually you're going to get caught on the wrong side. And in a week or two, you can give back a year's worth of gains, all because you were holding through a high risk time. To me, when the bars are red, when the market is mixed like this, it's a high risk time to hold stocks. Usually, a lot of times when we get red bars, there's usually bad news pending, something comes out. Big smart money flow kind of knows what's going on. And when we can pick up on there's big outflows, you're usually almost kind of front running some type of event. And then you just kind of got to let the markets play out from there.
Did you watch Donald Trump's interview with Fox Business yesterday? I think it was Monday morning yesterday. Somebody asked him, are you invested in the stock markets right now? And second part of the question, do you like Bitcoin? And he said, I'm not currently invested in stocks right now. I think it's a little bit high. Those are his words. So I think he would agree with you on valuations there. And he said Bitcoin's a scam. So on that note, let's talk about gold and Bitcoin.
Sure.
You said something very interesting to me offline. You were comparing the cycles of gold to that of Bitcoin. So let's take a look at both right now. Let's take a look at what you mean by that.
Sure. So this is the monthly chart of gold. It goes back to the 70s. And more or less, no matter what, stocks, commodities have bubbles. And it's not that they're a bad thing. It's just you need to know how to kind of dance around them because they're fast moving and they're dangerous. And if you look at gold, you can see here it went from $100 an ounce, rallied all the way up to 870 and change, a full-on massive bubble, had a big crack to the downside, had this complacency move, which you and I talked about in our last talk. And then gold collapsed and gave back most of its gains. And then it went dormant for a very long time. Commodities can go dormant for a decade or two. That's actually fairly normal. And then, of course, it went into another rally and then had started to consolidate and then had a breakdown and went dormant for 8 years. And now it looks like we're starting what looks to be another major run. This is far from a bubble for gold still, really considering it started, at, we'll just say 1,100 or so, and it's only at 2,000. It really needs to go to like 35, 5,500 to be a massive bubble in gold to equal kind of what was happening in the past here. So gold's on its way up and running. But this chart, if you look at it, these bubble phases and then going out of favor is exactly what's happened to Bitcoin 6 times since 2010. There's really no real difference other than Bitcoin moves a lot faster through this whole psychology wave. It's a very different kind of commodity or asset class. It also has a very different group of traders and investors around it, the mindset around it. So it happens very quickly. So we've seen 6 bubbles in Bitcoin since 2010 in the last 11 years. In gold, it's had kind of 2 bubbles in, since the 1970s. So it just goes to show you that, bubbles, they all kind of look and feel the same, and they're very dangerous. And usually most of the gains are given back, and then they flatline for a while, build a new base, and then they'll go on to eventually become popular, potentially have a blow off top, a bubble phase, and then burst, and then rinse and repeat. So that's what gold has done. It's what Bitcoin is doing. And it's totally normal price action for hot assets.
Chris, I just want to point out that if you look at the gold chart, the last two times we had gold reach then all-time highs, so 1980 and then 2011, what we saw was that after the peak, immediately the price fell down, and then it retraced, and then after reaching a bottom, it climbed back up to breach not the previous all-time high, but close to it, and then fall back down into a consolidating pattern that you talked about. It happened both times, actually. It's both times I'm looking at that screen, that was exactly the pattern. And if you look at what's happening now, it's showing pretty much the same thing. We reached a high last summer in August. It's come back down. We reached a bottom earlier this year. Now we've climbed back up to $1,900 an ounce. It looks like it might go up some more. But if you take history as a guide, if you assume that it's going to follow the pattern that it did the last two times, couldn't you say that, well, it's going to climb up a little bit more, and not quite at previous all-time highs, and then fall back down to a multi-year consolidating pattern? Could that happen this time, Chris?
For sure it can. I mean, you look at this is the pattern you're talking about, where it sold off and then it rallied up, and then it eventually broke down through here, and then went sideways. Well, we've got a similar pattern here, same type of thing. It's rallied up, had a very strong pullback. It's starting to break out. Yeah. The thing is, when you step back and you look at the big picture, this rally that's just starting, this is like the first pause and pullback. It's broken these two previous real standout highs. It's having its first pause and pullback. It's actually just, to me, in the infancy stage of starting another major run. It's kind of like the halfway point. If we look at this last time, we saw gold run up, and then it had a correction, and it pretty much did the same thing. It had this big pullback, and then it rallied up, except for this time, instead of it rolling over, it held up there, it ate through it, and then took off for the second half. And I think we're going to see the same thing. We're going to see gold hold up. It's going to try to eat through this, and then I think it's going to take off, and we're going to see, $2,600, $3,500 gold, all those things. So in terms of the cycle, this one is just starting. This is the first kind of hiccup on this new kind of bull market trend going higher. But there's no doubt it could very easily roll over and fall out of favor and chop sideways and be, drive everyone absolutely nuts who have been holding since the 2011 highs.
Oh man, you just had to spoil the good news. it's like here's a bullish analysis, slap across the face. Chris, so that's an excellent point, because what you're saying is, if you ignore the second part of what you said, if you assume that it could go up to $2,600 and $3,500, what you're saying is we haven't yet reached a multi-year top yet, because the last two times in those cycles, those were multi-year tops. And if you zoom out a little bit, if you go back to the 70s, it's taken years to reach that top. And that's also the differentiating factor I wanted to point out, which is that in 2011, for example, it took 6 years to climb to a top, whereas last year it took, a year and a half? Are we just seeing the time cycle being compressed right now, or is that, as you said, just the beginning of a 6-year kind of bull phase?
I think we could see it rally. I think we could see gold perform very well for 3, 4, 5, 6 years, maybe. I think it's picking up steam. I mean, there's a lot of financial issues going on. A lot of times it'll pick up most of its momentum right near the ends, and that's just how these move. We could see a very strong move out of gold going forward, but I do think it's still in the infancy stage. I think it's just starting a new major run. And it's going to take, I think, several years to kind of mature and get up there. I mean, a very small percentage of the population actually own gold in their portfolio. It's like 0.5% or something like that of people have gold in their portfolio. And then back in the 70s, if I recall, the average person had something like 1.5% or 3%. I can't remember what it was. I think Peter Schiff talked about it. but we are a long ways away from the average person owning gold and for it to be like a real, safe haven and hot commodity, kind of like Bitcoin. Everyone owns Bitcoin. Doesn't matter who it is. Grandparents own it. You name it. We're not even close to there with gold yet. So
if you either draw a trend line up to 2,600 or 3,500, can we just visualize that for a minute and take a look at what kind of a percentage gain we're talking about and potentially the timeline it would take to reach such a level?
Right. So if we were to look here, we're looking at roughly the measured move based from the low that we saw back in 2015 up to the recent high, back down to the low this year. We're looking at roughly 2,700. Give or take, up there to the upside. And based on this pattern, how it's unfolded, I would say it could be reached in the next, 1 to 2 years. That would be probably the earliest. Keep in mind, this is a monthly chart. So just 12 bars is a year. So it's going to take several bars to slowly kind of work its way up there. But usually the last rally or the second half of the push usually has a lot more momentum behind it, so it can happen quicker. So if this first one, say, takes several years, the next one could only take half that time or less, because it's just the way it happens. Momentum creeps in, people get bullish, and they get kind of in this euphoric stage, and everyone piles in. So it can very easily pick up speed and do that in a fraction of the time. I think it'll take probably longer than that, but who knows? These markets have a mind of their own. They kind of move at their own pace. You can never really gauge how quickly something will get there. So you just want to be in position right now. Gold is in this big bull market, creating a bull flag, starting to break out, and its next stop should be 2,700 over the next year or two. And gold miners should perform really well during that time.
Okay. Let's leave it there before you spoil it with a potential correction of 25% or something like that. But excellent. It's important to analyze both directions, which you've done for us. So thank you very much, Chris. Thank you for that update. I look forward to speaking with you next time.
All right. Thanks, David. Take care.
And thank you for watching Kitco News. I'm David Lin.